Financially raw, real, authentic wisdom with Lourens Oberholzer from Retire Rich and Happy.
Well, good morning everyone and welcome to another show of Financially Raw. It is Thursday the 3rd of June. Last week we weren't on, so I missed all of you guys. Thank you for joining me this morning, and I hope you enjoy the show. We're going to have a very interesting topic. I think this could potentially become a few episodes of the whole thing. We're going to really get into it today and step on a few toes, I think. So for everybody who's listening, thank you for joining us. We hope you enjoy the show. Also for our international listeners, we know that there's a few of them listening as well from Australia, from the US. Welcome to all of you. We will keep the Afrikaans to the minimum so that you can also understand what we are saying. My special guest in the studio this morning is Japie Venter. I'm not going to let Japie introduce himself again. Those of you who don't know who Japie is by now can just go and listen to one of our other episodes where he was the guest already. So Japie, welcome and thank you for joining me this morning.
Hi Lourens, and thanks for having me back. Yes, like you said, I'm looking forward to our topics today. It is going to be a little derisive. It's going to create a bit of a conversation, but I feel it's a conversation that we should have. It's important that people understand not only what's good about something, but also what's wrong and what to look out for.
Yeah, and I think the thing is, maybe just share with the listeners what is the topic, because we're starting talking about it and we haven't even told people. What are we talking about this morning?
The topic this morning is what's wrong with the financial services industry.
Yeah, and that's actually a very broad topic. And the fact that we talk about what is wrong in the industry doesn't mean we are upset with the industry, or we've both been in this industry for close on 25 years. So we've got a lot of experience, but there's definitely some things that are not working, and I think it is a good thing to discuss, and also for people, the public, to understand the challenges in the industry. So yeah, let's get started. Give me some of your thoughts. What's wrong with the financial services industry?
Well, Lourens, to sum it up, a lot.
We can go on for a while.
That said, like you pointed out at the beginning of the conversation, this is an industry we've both been involved in for 20 plus years. It's an industry we love. It's an industry we have a passion for. It's an industry we appreciate. And when we talk about the negative aspects, it's not criticizing. It's not pointing out what's wrong for the sake of pointing out what's wrong. Very much focusing more on what needs to change in order to give more people access, in order to help more people understand the system better so they can make more informed decisions. You know, the whole problem with the financial industry starts off with education. Our parents try to teach us to the best of their ability about how money works and how financial products work. The problem is they didn't know either. They went on hearsay, they went on experience, and most of those experiences were bad. So then they sent us off to school, and the main focus of the school at the end of the day is creating employees, not creating entrepreneurs.
Yeah.
So yes, there's in recent times new subjects that started, life orientation and so forth, but still they gloss over so many aspects of the financial services industry, focusing a little on, you need a budget, but never getting around to telling you this is why you need life insurance, this is why you need to invest, and these are the pitfalls to look out for. So education and the lack of education is a very, very big problem in the financial industry.
Yeah. I think just to pop in there is the fact that the schools are basically focused on creating a good army of employees, so that people can go into the world and earn an income and look after their families. But they don't teach us what to do with the income once we've earned it. And that's why so many people, by the time we start coaching them or we start working with them, they are battered, they bruised, their expenses are higher than their incomes, they have all this unnecessary unsecured debt or consumer debt, and then people look at them and say, but you've done some stupid things in your life, why did you do this? Instead of focusing on the root cause of the problem, which is the lack of education.
Very much so, Lourens. You know, hindsight's 20/20, like they say. And I feel this all starts off with goal setting. from a very young age, we're all taught to set goals, but we don't understand really the essence of setting a goal. Setting a goal is not trying to achieve a certain item or a certain specific product. You don't set a goal of, I want to drive this car or live in this house. Goal setting is much more about the standard of living that you associate with having that item.
That's what it actually means to you.
Definitely, and that's why people end up in these situations where they have so much unsecured debt, where they are drowning on a day-to-day basis, because they're trying to chase this item instead of understanding the lifestyle associated with it, and trying to achieve that lifestyle, but also very much understanding their own personal finances and understanding what means they have available for themselves and living within those means.
Yeah, I think when we look at school education, like you say, they do try and do a little bit of financial education, but it is very much glossed over. And I think that a big lack is that people come out of school, even though they've been taught what is a credit card, what is a bond, for example, or a mortgage for our international listeners. They don't have a practical plan to follow. I believe it should almost be a system where they tell people a step-by-step process they need to follow in the first 10 years or 15 years out of school that says, do this first. Once you earn your first income, put these things in place. Then once you've put that in place, then do the next thing. But there's no practicality to it. It's like a generalized idea of what these things are, but there's this huge knowing-doing gap. People don't really know what to do to make it better. And before they know it, the expenses are higher than the income, and then they're in that rat race, then they're in that problem, and they can't get out of it.
That's so true, Lourens. You know, again, focusing on, this is a credit card and this is a bond or a mortgage. When do people get around to actually using those financial products? Surely...
Late 20s,
Yeah. Surely there's no 18-year-olds running around applying for a bond. So what is the use? By the time you reach your late 20s, you've forgotten all about those things.
Yeah.
And that leads to another problem in the industry, a lack of a lack of willingness to assist young people and lower income groups to better understand the system. Like you say, to provide them with kind of a step-by-step blueprint to say, right, guys, first thing you're going to do is get a source of income for yourself, whether that be employment, whether that be starting your own business, doesn't really matter. Once you've started earning an income, now you go and you do this, and then you do that. Instead of looking at things that's going to have an impact 10 or 20 or 15 or 25 years from now.
Yeah. So the thing is that financial advisors are the guys that actually work with people. So now we're moving from the schools to the actual financial services industry. So if the schools aren't building that foundation and that practical step-by-step process, the next people in line that should actually work with clients from a young age and start teaching them practical steps are the financial advisors, because most of your personal financial advice guidance comes from a financial advisor, a broker, whatever they want to call themselves. But unfortunately in the industry, we're still sitting with a situation where the industry is incentivized to sell products, because the financial advisor don't get paid unless he sells a product. And that is a huge problem. And again, I'm not saying the answer is to take all commissions away. That's not what we're saying. We've been in this industry for years. But we need to find a way in this industry where people are actually incentivized to take the effort, take the time with their clients to educate them and be compensated for that. And it's not just an industry issue. It is a consumer issue, I think, as well. Clients, people that are the public needs to start thinking about or being willing to pay for this kind of advice and this kind of guidance, because people tend to think that, well, I should be given this for free because he gets commission, and that's not the right way, because you are creating more and more of that problem of being sold products because otherwise that person doesn't get paid.
That's so true, Lourens. From 2008, when the FIRES legislation came into being, the focus on the industry was to become more professional. And it's strange, like you say, consumers are willing to pay for professional services. You don't expect to go to a doctor and
Not
get
pay.
advice for free.
Yeah,
You
for
don't
that
expect to go-
consultation.
You don't expect to go to a lawyer and get advice for free. So the consumer out there needs to understand that as a professional service, these people need to be compensated as well, because it creates this vicious circle at the end of the day. Your mom and dad has a broker who's been looking after their stuff, or so they are convinced. Meanwhile, he's been selling them products. And the first thing mom or dad tells you is you have to meet up with
Wimpit.
There we go, Wimpit. He'll help you. And Wimpit gives them exactly the same advice that he gave their parents. So
In a
how's
completely
that
different
working
world,
out?
yeah.
So how's that working out for you?
Because we're still sitting in the situation where we have a retirement crisis. People cannot get to retirement. 96% of people in South Africa can't maintain their standard of living within 5 years after retirement. So if when Pete comes and gives you exactly the same advice that he gave your parents, you're going to get exactly the same results as they did. And again, people are not getting there because of a lack of knowledge and a lack of education and a lack of practical strategies for them to follow.
It's because, unfortunately, still in today's times, there are so many brokers running around not looking at the interests of the clients, but looking at their own pocket, like you rightly pointed out, because of the commission-driven system. And yes, we're not saying do away with commissions. What we're saying is people need to understand the value in a professional service.
Yeah. So, and this is something from somebody who's been in the industry and working on commission or earning commission from doing business with clients. I mean, I started in the financial services industry as a typical financial advisor. And we are the only industry in the world where you go and do work for a client. And the way we do it, it takes hours and hours and hours of planning, strategizing with the client to get a final plan of action. And then we go and we do that business with the client. And then suddenly we are now attached to the hip with that client forever, basically, but specifically for the first 2 years in a very close sense. And then if that client does something that is completely out of our control, he goes and he gets retrenched, or he steals from the company and he loses his job, and he cannot pay the plan that we've put in place for him, we get penalized for that. We've done all the work, we've given our advice, our knowledge, everything that we've built over 20 years to them, and then everything gets taken away from us for the work that we've done. And unfortunately, that is not a fair system both ways. It's not fair for the client, it's not fair for the people in the industry. There's definitely going to have to be a relook at how this whole compensation model works. And I think it comes from both sides. It doesn't just come from the industry, it comes from clients as well. Clients need to start looking at financial advisors or brokers more as the lawyers, the attorneys. And if you start doing that, you'll very quickly start realizing whether the person you're working with are one of these people, or are they just trying to sell you something.
And that brings us to the main problem, the whole sales function. If advisors in the industry want to be seen as professional, they have to act professional as well. You don't get lawyers phoning you up and say, can we please have an appointment so I can explain to you how you can possibly go through divorce proceedings. Your doctor doesn't phone you up and say,
are you sick?
Yeah, maybe you should come in so I can check if you're sick or not. But unfortunately, that's the system financial advisors are caught in. They have to keep on contacting clients. They have to keep on repeating the sales process because of the lack of education, because of the lack of willingness on the consumer side to understand the profession better.
Yeah.
So you end up in the situation where a lot of brokers running around and they just try and sell policies. So they'll sit with a client and say, oh, but your investment at XY company only performed at 5% last year. ABC investment company performed at 10% last year. And you go, ooh, yeah, that sounds great. So cancel all of this and transfer it to the new company. And it doesn't work that way.
Yeah. The only person that benefits in that scenario is the insurance company and the financial advisor. It's very, very, very seldom that the client benefits from something like that. And again, to just go back, I thought of something again on this this clawback of the income that people in our industry get. It's almost like you buy a house. The estate agent takes you around and he gets his 40,000, 60, 70,000 rand commission because he sold you the property. And then 3 months later, you get retrenched, you can't afford the property anymore, so you sell it again. And then that agent, they go back to that agent and say, well, now you have to pay back that 70,000 rand because this person didn't keep his property for longer than 2 years. It is absolutely ridiculous if you look at it in that sense. I mean, the fact that the client has stopped paying for that property hasn't changed the fact that the agent did his job. He spent money, he spent time, everything to get that sale. So yeah, there's definitely something wrong. When we look at the investments that you're talking about, and that's for me is a very important thing. Yes, the FASE Act was brought in to make it more fair, treat customers fairly, to TCF. And in there, they specifically state the Financial Services Board, the FSCA, whatever that stands for these days.
Financial Conduct Services Authority.
Yeah, it's a Financial Services Conduct Authority, you see, OCD. Anyway, and in there they state that a proper analysis should be done or assessment of the financial needs of the client.
Yeah,
but nowhere do they go and specify or define what a financial analysis actually is. And that creates a hang of a big grey area.
Lourens, we've been having this conversation, you and I, since 2008. Initially we said, okay, cool, they'll get around to it. Remember, new legislation, things will change, they'll understand better. The problem with this legislation is it was put together by people who have never sat down in front of a client. So let's focus on the whole idea of a financial needs analysis. You get so many companies out there who now include a form of analysis in their quote system, where they ask you, so how much cover do you want?
Yeah. How much do you think you need?
And that's defined as an analysis.
Yeah.
And that is not in the best interest of the client. Again, it reinforces the sales function. How can I get in and out of the door as quickly as possible? Which leads to a lack of education, which leads to a lack of acting in the best interest of the client, which perpetuates this problem generation after generation after generation. Again, we've been in the industry long enough to see generations of people suffer from the problems in the financial services industry.
Yeah. The one thing that we need to look at is the kind of products that the financial services industry also offers people, because I do believe, and I think that's us as a company, our approach is that the financial services industry doesn't necessarily need more innovative products. It needs more innovative advice and education. There needs to be more of a focus on educating people, and not in general education, practical things that people can go and do and implement. And what happens with this is, because financial services products are 95% the same thing, whether you do it through the one company or the other company, they're 95% similar because they're all regulated by the same rules and regulations, and they're all underwritten in the long run by the same reinsurance companies. The insurance companies then start fighting on the 5% that they're different, and then they create all of these bells and whistles and almost said bullshit, but I'm not going to, that they add on top of it. Yeah, luckily I didn't. They add on to these things to try and make it look better than it actually is.
Lourens, you're getting to another core matter. 95% of products worldwide are exactly the same. Whether you pass away in South Africa, whether you pass away in the United States, United Kingdom, Russia, Australia, it doesn't matter. Your life insurance will pay out given a certain set of circumstances. And that's where the little 5% comes in. Because people get hung up on the 5%. And again, that gets back to education, gets back to the sales function. people will run around, and the advice they receive is, you need 2 million rands worth of life cover so that when you pass away, your wife will get 2 million rand.
Yeah.
Yippee.
What does that do exactly?
What exactly does that mean to the standard of living of my wife and my kids? And that's where more innovative advice needs to come in.
Yeah.
Because products are largely the same. People need to realize that there's questions they need to ask their financial advisors about specifically bells and whistles, about rewards programs, about benefits that will benefit them in the long run, not in the short term. I can get cheaper gym membership, which you're paying for, guys. You're actually paying additionally for it.
Yeah, it's always built in. Don't think any insurance company, financial institution, bank is there to give you money. That is not what they're in business for, and that's how it should be. They shouldn't be in business giving people money back. That's not the idea. It should be a business where companies can profit, because in the long run, it's in the best interest of the population if there are proper insurance companies that are stable, that are financially solid. So insurance companies need to make money. Banks need to make money. That's the reality of it. But it should still be a mutually beneficial arrangement. It can't be that they make money out of people unnecessarily. And that's, I think, where a lot of these bells and whistles, paybacks, bonus, rewards programs come in, where it's more geared towards what the insurance company can get out of it than it is actually what the client can get out of it.
Again, we mentioned this in our last show, Lourens. Insurance companies have very, very smart actuaries who sit down and do calculations, so they know exactly how many people make use of the bells and whistles, which is technically costing them money.
Yeah.
So they sit down and they say, if we launch this to 1 million people, only about 20,000 of them are actually going to use the product. The rest means we're getting money in on a monthly basis, which is benefiting the insurance company. And the advisor runs around and sells these products because he's incentivized through the commission system. Again, not acting in the interest of the client, sitting down and answering the hard questions about what are the goals, what are the needs, how do we approach this in such a way that it's tailor-made for you, not a cookie-cutter assembly line process where, you need to have this, this, and this, and off they run again. When something happens to you, you hope and pray that you can get hold of this person again.
Yeah, and that's the thing is, whenever you meet with an advisor, when somebody works with you, a broker, a financial advisor, whoever, you as the client need to ask yourself, am I getting guided to where I'm going, or what I need to go, what I want to achieve? And if my broker or my financial advisor isn't asking me questions to determine exactly what it is that I want to achieve or need to achieve, then I'm probably being sold. I'm not being guided. Because that's what happens. The financial advisor, the broker comes, they sit with you, they tell you what you need, they tell you how much better this product A is than product B, and because they're so convincing, you then go from product A to product B. But if it's not tailor-made towards what you actually need, then you're probably being sold.
That brings us back to the definition of a financial needs analysis. A financial needs analysis is not what do you think as a capital amount you would need. It is focused more on a monthly basis, on a daily basis. What are the future expenses? What are the future goals? What are the future things we want to help you achieve? And are they realistic?
Yeah.
Because sitting back and telling a client, don't worry about it, we'll get there, means you are not going to get there. And touching on comparing product A with product B, guys, 9 out of 10 times, as soon as somebody starts comparing one product to another product, you're being sold to.
Yeah.
At the end of the day, the product house does not really make a difference. Again, 95% of products function in essence in exactly the same way. So whether you invest through this company or that company, whether you take your risk cover through this company or that company, it is the same thing. So the conversation is not supposed to be about the company. The conversation is supposed to be about how we're going to address your needs and how we're going to do it in an affordable way And then what is the plan going forward? Because financial planning is not a get-rich-quick scheme. It is not something that happens overnight. It's also not a fire and forget plan. It's something you need to work at. It's something that needs to be reviewed annually at least. And people, consumers, also have to realize that as an advisor, I don't have access to your life on a day-to-day or month-to-month basis. So the conversation needs to be a two-way street. Yes, we follow up. Yes, we do reviews. But that usually happens twice a year. A lot happens in 6 months. And if you do not contact your advisor, if you do not inform them, there's no way they can know about anything.
To make and give you the right advice.
Very much so. To give you the right advice. You know, in South Africa, unfortunately, we suffer from so many people immigrating, so many people being retrenched and having to take their pension funds to either restart their life or to just go and blow the money or to go and buy a house or a car or whatever the case might be. And how then do they recover from this setback? I mean, they've spent the last 20 years working. Now they take out the money, start over or start a new life. Guys, the retirement crisis Lourens keeps referring to is not a South African phenomenon. It's an international phenomenon.
Yeah.
We need to understand that savings alone will not get you to retirement, irrespective of which product you use, irrespective of which company you use, irrespective of whatever nice graphs and bells and whistles insurance companies or investment companies wants to add to it. That's why we have the 5-step program.
Yeah. And that's the thing, as I made a note here about unrealistic expectations that I have a big issue with as well when financial institutions start advertising. Let's look at the newest, best retirement annuity that they've now just launched. And then they say, if only you put money with us, you will be fine for retirement. And they create this picture that in the event that the clients puts 500 Rand a month with them, they're going to be fine for retirement. Instead of, and I know it's a marketing spiel, I know it's about advertising, but the reality is never addressed. I mean, how many conferences have you been to in this industry? How many workshops have you attended in this industry? And do they really address the issue that people cannot retire? They don't. They say, well, we have a problem. And then they say, but we've got this new retirement annuity. If people just save in this, they'll be okay. Or if people just save in that. And you can't fix the problem with the same thing that brought us into this problem in the first place.
Lourens, yes, you know, the problem again keeps on perpetuating itself because of the advice received. I've got no real problem with an insurance company saying, if you invest in our product, you can get to retirement and everything will be fine. Like you say, that's marketing. That's what these guys are supposed to do. But then the advice from their advisor, from their broker, needs to be realistic. There's no way, guys, that you're going to put away 500 Rand on a monthly basis and end up with 20,000 Rand at retirement. There's no way you're going to put away 15% of your salary on a monthly basis, as they tell you to do, and end up in a situation where you can retire comfortably.
Yeah, replace your salary.
It's not
15% doesn't become 100%.
It's not going to happen. And again, getting back to people only realizing that they need to start looking at retirement in their early 30s or late 30s, early 40s. Guys, you're not going to save enough. It doesn't matter if somewhere along the line you withdrew your retirement funds or not. Yes, you probably immigrated or moved for financial reasons, for safety and security reasons, but the basis of financial planning stays the same, irrespective of where in the country you are.
Yeah.
Go and look at our website. Have a look at the 5-step process. It makes more sense.
Yeah, you have to. You can't do what everybody else did and expect. Definition of insanity: doing the same thing and expecting a different result. You can't do what everybody else did and think that you're going to be the exception to the rule. See, for our international audiences, I put a little Afrikaans in there. Be the exception, and suddenly it's going to work for you instead of something else.
because the insurance company or the investment house would have you believe that this bell and this whistle, because this thing is integrated with that thing, and if you save with us for X amount of years and combine this with that product and that product, you'll be okay.
Yeah.
You're not going to be.
Yeah. And that's another thing that when you talk about this whole thing about combining different products, and as long as you have this product, you will get this bonus. And yes, it looks good on the front, but when we look at doing a financial analysis, we always have to look at what you need first, not what you have. And that's the problem. There's too much focus on what you have and trying to beat what you've got. Whether that is on risk, whether that is on investment, doesn't matter. And with these products being all integrated or all connected to one another, what typically happens, people get into a situation where eventually, as they get older, they're sitting with risk that they're paying that they don't need anymore. But they cannot cancel or reduce the risk because then it has an effect on that bonus, or that, I call it funny money, that promises of grandeur that they give you. And now you're stuck. You're stuck with a risk cover, an expense that you can't stop because you're losing out on your investment side, which is a ridiculous situation.
You end up with people approaching retirement, age 60, 65, the traditional retirement ages, who are paying for risk cover, like you say, of 10 million rands worth of life cover. The
Which
kids are 40 years old for no apparent reason.
Yeah. Because if they cancel it, they lose their bonus that they were going to or waiting for the last 20 years.
And it goes directly, or it is directly in contrast with how we look at risk cover, how we look at the need for risk cover. Your need for risk cover reduces over time. It does not stay the same. Very seldom does it actually increase. If the planning was done properly up front, you should be able to reduce your cover annually or at least once every 2 years, and still maintain that standard of living should something happen to you, should one of these unforeseen events occur.
Yeah. We've got two shout outs on the website. Harry says, he has a question. He says, lump sum versus recurring investment, investing. What is the difference? So that's a good question. We'll quickly jump in. It's a little bit off topic, but we'll quickly answer. And then Bob just says it's a great show. Thanks, Bob. Thanks for listening. Got a question here from Francina Ace. Hello, Francina. Nice to have you on. If a financial advisor did not do the right thing and did not do a proper analysis, can we report him or her, or do we just leave it and move on? Just don't want everybody to fall into the same trap. Yeah, I'm sorry to hear. I assume you've had some bad advice. So Japie, if you let's chat about the first question quickly. That's a relative quick one to answer, and then we can give Francina a bit of guidance as well. So Harry's question: the lump sum versus recurring investing. What's the difference?
Lourens, it's a very broad question, and I think that, sorry, it's Harry.
Harry, yeah.
Yeah, Harry, I think you're trying to actually ask another question, which would be best, lump sum investment or recurring. But definition of the two terms you're referring to, lump sum investment would be any time you have a capital amount of money, 100,000 to 200,000, which you invest in a product, and it's a once-off investment. You don't add to that investment again. That then grows over time, hopefully, and you get a payout at the end of the day. A recurring contribution would be you making a monthly or a annual contribution to a product, again for a certain time, so the contribution is reoccurring. You do it more than once, and after a certain period of time, if you've received the correct advice, you will have a payout which is bigger than the amount of money you invest.
Yeah. So I think that one of the big differences between lump sum and recurring is the way you get into the market. With a lump sum investment, the moment you put it in, you buy into the market at whatever the price of those units are on that day. And then you're in it for the roller coaster ride. So if the market goes up, your investment goes up. If the market goes down, your whole investment goes down. So you're in a roller coaster. If you do a recurring investment, you are buying into the market every single month or every single year or whatever that recurring is, which means that whether the market goes up or down, when it goes up, your existing capital grows, but when it goes down, you're buying units at the discounted price. So in the long run, you'll probably get a better return on a recurring investment than you would on just putting a lump sum in if you take it over an average of a period of time. So I hope that answers your question. If there's more, you're welcome to send us some more questions, and we can do a show on that and talk a little bit about how returns are.
Topic.
Yeah, how investment returns are calculated, etc., etc. And then Francina, what do we do with people who don't give proper analysis or didn't do a proper analysis? Can we report him?
Francina, yes, definitely you can report them. But your question again poses a problem. Because analysis is not defined anywhere as what is a proper analysis. So we have to focus on the advice component. Was the advice you received at that point in time relevant to the needs that you had? And did it address those needs?
Yeah.
If your financial advisor did not do that, then definitely they can be reported to the various ombudsmen, being long-term or short-term. You can even approach the FSCA directly and be in contact with them. Remember, ours is an extremely regulated industry, and we have to jump through a lot of hoops in order to do our work and to do it properly. And you do, unfortunately, still get cowboys out there who make promises they can't keep up with, who try and sell products just for the sake of selling instead of acting in the best interest of the client.
Yeah, so what's important there, and like Japie said, just stating that a proper analysis wasn't done is a very difficult thing, because currently, as we have legislation at the moment, there's no pure definition of what a proper analysis is. So it's going to be more focused around what was the advice given according to the needs that you have, and did that advice directly lead to you suffering some kind of a financial loss. So if that is the case, you are in your rights to go and open a query or report the person at the Ombud. But it is very important to understand that just the fact that the person didn't do an analysis doesn't necessarily mean you can take him to the Ombud. You have to have suffered some kind of a financial loss as a result of the advice that was given, specifically because that advice wasn't tailored to the needs that you had. It was more tailored towards selling a product. So I hope that answers your question, Francina. Again, you are welcome to contact us if you want more in-depth advice on that. So let's talk. We have a few minutes left, and yeah, there's so many things we can talk about. But I want to just touch on the fact that the products have become so complicated over time, and the problem with that. So if you want to talk a little bit about that, Japie.
Lourens, when we do planning, we focus on the core questions that need to be answered. What would be needed in the event that you pass away? What would be needed in the event that you become disabled? What would be needed in the event that you get diagnosed with a dread disease? And then we find a product which addresses those needs and addresses them in the most direct way possible. Complicated products again come in with bells and whistles. It comes in with rewards programs where if you should pass away because of this or because of that, then you will get an extra 10,000 Rand. If you integrate this with that, then we can increase your life cover by Y. And it leads to confusion. You know, when we speak, for instance, and I know I'm focusing on risk now because investment gets even more complicated. Just quickly touching on investment, there are so many products out there, and there's no set standard way of how to calculate fees on those products. Everybody kind of charges whatever they feel like and hides it in different line items. So comparing one investment's fees with another investment's fees
becomes a nightmare.
Is near impossible. Very much the same with medical aid. Comparing one medical aid on an apples for apples basis with another medical aid is near on impossible. But getting back to our risk product, because it's easier to explain to people. You get so many insurance companies these days which decided that we as advisors give the advice that you need an income should something happen to you, and then offer you the option when you become disabled of, instead of taking an income, rather getting a lump sum amount of money.
Yeah.
Now,
Things like that.
that's contrary to what you actually need. If you needed a lump sum amount of money, that would have been taken into account during the planning stages. So insurance companies try to be innovative with products. They try and create more selling opportunities instead of allowing the advisors to give more innovative advice by keeping products as basic and simple as needs be.
Yeah. What you said there is so true. When you get, and I know specifically one of the companies with their severe illness. Now, severe illness, for the listeners that don't know, those are the cancers, the strokes, the heart attacks, those kind of things. And what they do is they give a certain amount of cover, and then when you have you do one or other level on their program or the rewards program, and you then have a claim, then you'll get 100% extra. You'll get 200% payout instead of 100% payout. The question I always have is, well, if you needed 200%, so if you have $1 million cover, and if you are on level X of their reward program, you will get 2 million. Well, if you needed 2 million, why didn't you just take 2 million? Why have this potential? Because don't think you're not paying for that, but they sell you on that idea. We believe that you go, you look at what the needs are, you cover those needs, nothing else. The purpose of that is not to create wealth. The purpose of that is to make sure that if anything happens, you can continue in the same manner. So if you needed 2 million, have to get 2 million cover. If you don't need 2 million, then don't worry about a bonus or an extra which you are paying for in any case. So they overcomplicate these products. Last time I think we spoke about primary and secondary risk areas, and the focus is always get your primary risk areas sorted out. Forget about the secondary risk areas until your primary risk areas are sorted out. But they're so busy creating, and exactly what you're saying is, if we do planning for a client, we say you need X amount of income, X amount of capital, then give the client the option of converting the income to capital. It doesn't make sense. Why would you want to give that to a client if that wasn't the need that needed to be addressed? Yeah, so Japie, we've run out of time again. I think this is definitely something we can discuss even more. I think one of the things we need to talk about is how the insurance industry corrects for any risk, like where we're sitting in COVID now, where they just completely or exaggerating issues with clients, how that works and what the detrimental effect is for clients on that. But thank you for joining me this morning. Unfortunately, we've run out of time again. I'll definitely have you back. Guys, you are welcome to follow us on Facebook. We always have content on there. You can follow us on YouTube. These shows are all put on YouTube. So you can just search for Financially Raw, and then also go visit our website, retirerichandhappy.co.za.
Financially Raw, real, authentic wisdom with Lourens Oberholzer from Retire Rich and Happy.